Are you able to share some of your favorite explorers, like your top two?
I remember I was sitting down on my computer and I was gonna hit the bid. They were trading at 18 cents. And so that day, it was in July, they went up to, I think, 22 cents in the span of time that I was gonna put my bid in. It went up by like 4 cents, and I said, oh, it's gonna go down. Well, I watched it for another several weeks and then finally started to buy at about 40 cents. And at the peak in November of 2021, when Split started buying uranium, and we did very well during that run in the fall, it was up at $6 a share. There's a lot of value there. They announced last year that the deposit that they found is about 50 million pounds. The neighbor there is Cameco, and Cameco is drilling right on their border, so they know that there's uranium on the other side of the property line. So, I think that's going to be a good takeout candidate.
Hello and welcome to Capitalcosm, everybody. Today we have another special guest. We have Terry Papineau on the show. Terry, thank you for coming on.
It's my pleasure, Danny, and welcome from beautiful French River, Albin, Ontario.
All right. Awesome. Well, before we get started, though, nothing in this video is financial advice. Neither Terry nor I are financial advisors. Please do your own due diligence. It's your money, your responsibility. All right. With that said, Terry, again, thank you for coming on the show. Can you give the Capitalcosm audience an introduction of who you are and why uranium?
Sure. Well, I'm a retired superintendent of education, and I also have a strong interest in the financial markets. I did a brief sort of part of my career was in financial planning, where I had a book and I had my own clients. I ended up selling that book. So I started as a teacher, went into financial planning, then went back into education. But my love for finance and investment was always there. And so I began my foray into financial planning in 1996, and I've been observing the markets very, very closely since then. I noticed different trends that were occurring, and at some point wasn't able to take advantage of those trends. I only saw them, after. However, I was able to look at gold. Gold, for example, in 1997 was very low. I think it was selling at $270 an ounce. And so I started recommending some gold funds to my clients. And the human psyche is different. Like when people see like a negative on the returns of something, they say, well, why would I put my money in that? Well, because it's cheap now. And if you buy when it's cheap, at some point in time, that the market will recognize that there's value there. And it's like going to the supermarket and buying soup. If that soup that you buy every week is on sale at 50%, you're going to load up on the soup. So, but people never didn't associate that concept to investing. So so I saw that in gold. I also saw a bubble in the tech sector at the end of the 1990s. Like that bubble was evident to me. There were valuations of companies that were just completely ridiculous. That's when people started investing on their own, through the internet, and different platforms came up so that people could start investing their own money from home, from their own account. And a lot of people were there were 4 or 5 different tech companies that were doing their IPOs almost on a daily basis. And if you could get in on those IPOs, you would do 5 times, 10 times your money that day. So it was just ridiculous, the bubble in the tech sector. So I saw that. And then I witnessed the uranium bull market in 2005, 6, and 7, and again was not able to get in on that because I saw it happen as it was happening, and you're just trying to chase it, and I wasn't chasing. But I did see the oil just a little bit later. The oil was selling at $39, $40 a barrel. It was bottom bouncing, going from 39 to 40 to 41. And I told it, like, it's not going to stay at $39 a barrel. Like this thing about electrification and all that, there's still so much demand for oil. So I got in on oil, and in the span of about a year, it was up to $80, $85. It came back down since then, and then went really low last year when Russia invaded Ukraine. But sorry, not when Russia invaded Ukraine, but in the pandemic in March of 2020. But it went way back up last year. So I was able to identify these trends, and that really identified my investing style in terms of trying to find something that's way undervalued, and that at some point in time that value will be recognized. And remembering what had happened in the last uranium bull cycle, where the sector absolutely went ballistic, and people that were fortunate enough to get in at the right time made a lot of money. When I started to get information related to that in 2016, and that came from I was watching BNN, Bloomberg News, and there was a respected analyst that was talking about Cameco, which is one of the bellwethers in uranium, and saying that each Cameco was the bane of his existence. Like, it was such a great company, some of the best assets in the world. I mean, you could look up, just Google most richest mines in the world, and Cameco's McArthur River and Cigar Lake, they're in the top 5. I think they're in the 2 of the top 3. That's compared to any other metal, any other, like gold, silver, you name it. Their 2 uranium mines are 2 of the richest mines in the world. And so they've got great assets, great management, a niche in the sector, but completely unloved. So that really grabbed my attention, and that's what really got me starting to try to find all kinds of information on the uranium sector. And I did. And in 2016, 2017, 2018, even 2019, there was no information, very, very little information was coming out on the uranium sector or the nuclear sector. There were some videos on YouTube, but mostly uranium company CEOs that were doing interviews. There was a few people that would talk about it, like Nick Hodge and Gwen Preston and Rick Rule, that would talk about once in a while. Then I found Mike Alkin from Sachem Cove, and Mike Alkin was really sort of the best objective kind of he had some serious experience behind him, as well as a past hedge fund manager and a short guy. And he had a podcast back then, talking stocks over a beer, and that came out about weekly. I was listening to that all the time, and then discovered John Quakes on Twitter, and John Quakes would start posting a lot of information that he's excellent at providing information. And then discovered Justin Hune at that around 2017, and we started calling one another, and different people like that. Andrew Weekly from Smith Weekly as well started calling one another. Trader Ferg, who also started talking about uranium, and then just started sharing information, and that's how it kind of grew. And then that's where my conviction really developed, and that's when I started in 2017 is when I started to invest in uranium equities. And so when I started to invest in uranium equities, my shift focused, as well as my conviction in the sector grew, and as my knowledge of the different companies grew, and as I was analyzing also the last uranium bull market. So I started by investing in like the producers and the developers. And then I kept some developers and some past producers, and then I started to invest more heavily into explorers. And my strategy was that if I can invest in a basket of good quality explore. Well, sorry, not invest, speculate in good quality explorers. You know, one of them might hit something, and if they do, then those returns can be quite significant. And so I had a basket of about 9 explorers there, and I was lucky enough that three of them hit. And so the returns on those 3 were fairly good. And my thinking was, well, if 1 or 2 of them can hit, then, you know, and the others don't do so well, well, the ones that hit might, you know, do well enough to mitigate the losses that I might have to incur with the other ones. And I want to put a caveat here. Like, I have absolutely no idea, and no one does. No one can say which explorer, you know, who's drilling is going to hit the mother lode or something significant. Nobody. It's so difficult to find something. So that's why I was in a basket of explorers. And you know, when I say quality explorers, to me, a quality explorer is, you know, a company that has half decent properties in good jurisdictions with management that does what they say they're going to do, that has experience in the past, and that tries to take care of shareholder money, not to dilute too much. And so that's been my strategy. So now probably 70% of my portfolio is in explorers, and the other 30% is in past producers or developers.
Got it. Nice. Are you able to share some of your favorite explorers, like your top 2 or anything to that effect?
Sure. Like, so now I think that my top explorer, like my best success, was a company called ISO Energy. And I was looking at that company in 2017, 2018, and I first wanted to buy shares of ISO Energy when, and I remember I was sitting down on my computer and I was gonna hit the bid. They were trading at 18 cents. And so that day, it was in July, they went up to, I think, 22 cents in the span of time that I was gonna put my bid in. It went up by like 4 cents, and I said, oh, it's going to go down. Well, I watched it for another several weeks and then finally started to buy at about 40 cents. And at the peak in November of 2021, when Split started buying uranium, and we did very well during that run in the fall, I think ISO Energy was up at $6 a share. So that's the kind of, you know, that's the kind of returns I was looking for. I still hold ISO Energy because I still think that there's a lot of value there. They announced last year that the deposit that they found is about 50 million pounds. They have good, you know, they have the neighbor there is Cameco, and Cameco is drilling right on their border, so they know that there's uranium on the other side of the property line. So, you know, I think that's going to be a good takeout candidate. And as part of my research, if you really do the work, in the past bull market in 2006, 2007, where, you know, some of the quality properties that had uranium in the ground, you had companies like Cameco and other companies throughout the world that wanted to buy these properties, these projects. And these projects were being sold for, on average, around $10 per pound in the ground. So that's in 2007. So if you use 2007 numbers, ISO Energy that has 50 million pounds in the ground, if they you know, had been in existence and they had that deposit in 2007 and someone would have wanted to buy them, they would have, you know, been sold at around $500 million. I think their market cap is sitting somewhere around 250 million right now. So, you know, in 2007 numbers, like, again, this is all speculation, but
and that's not even inflation adjusted too.
That's how I'm kind of doing the math in my mind in terms of, well, you know, if you use 2007 numbers and a company wanted to buy them out, in 2007, they would have been paying about 500 million.
That's kind of your lower bound.
and those are the numbers I use when I do my models. So, I think that it's safe to assume that if a company gets bought out in the upcoming uranium bull cycle that we're in right now, and if someone wanted to buy out ISO, management at ISO would not sell that company for $10 per pound in the ground. They would sell it for more than that. I mean, 2007 is 16 years ago. So they won't get bought out this year. They might not get bought out next year. And, but in my mind, it's safe to assume that this company still has room for more returns on my speculation in ISO. So ISO is my best success. And then the other two are baseload energy and fission 3.0. And I think fission 3.0 or F3 now is a very good story to tell, because that company, before I get into F3, I want to finish with the ISO. So ISO, that the deposit that they have, that's just on one of their properties. They have other properties as well, good quality properties in the Athabasca Basin, on which they can continue exploring to maybe find more deposits. So, and as we know, the Athabasca Basin is the most prolific place on the planet to find uranium. So, like, I'm not saying they're going to find another deposit, but there is value in those other properties that they own. So fission is F3, fission 3.0 is the same sort of story. And so fission, they had a bunch of properties that were spun off from fission when fission did their triple R deposit. And so F3 was born, and they had a bunch of properties there. And during the bear market, from 2011 to 2000 and let's call it 2020, they just stopped operating. They did very, very little to bring costs down, keep the lights on. It was difficult to obtain information on this company back then. And so, and the shares of the company, like, they went down at one point. They were at, I think it was 6 cents. And myself and a couple other buddies, we bought into a private placement in the fall of 2021, I believe. Yeah, the fall of 2021. And I think I paid 26 cents a share for that private placement. And then we watched the price go down from 26 cents that we paid to about 6 cents. And one of my buddies was calling me and saying, "Oh, what the hell's going on with the company?" Well, the whole financial markets last year went for a tank. They haven't had a chance to explore yet. There's no news coming up. People are just pulling out of any investment they can. And then they came out with the news last fall that they hit significant, pretty juicy results on 3 of their 4 holes that they drilled last fall, and they went back this winter and they hit more uranium. So, and then they came out with a news release last week that said they did a 75-meter step out, and the results are pretty encouraging. And they're going to be going back this spring, shortly in summer, to drill more holes to try to define how big is that deposit. Will it be a mineable deposit? Will it be 10 million pounds? We don't know. This is speculation, right? These are all unanswered questions. But, in the span of a very short period of time, the share price from F3 went from 8 cents to about 45 cents. And so it's sitting at about 31, 32 cents right now. So, their market cap is about 100 million, give or take. And that's a very, very similar story to ISO. So if they find, like a 50 million pound deposit there, and someone wants to buy them out, if it's a good deposit, and there's a lot of ifs here. That's why it's speculation. But that was my strategy. So my best performer has been ISO, and then behind those two are baseload and fission. But I mean, Alaska is another great company. They're hitting uranium as well. You listen to any geologist that knows anything about uranium, the best place to find uranium is where you've got uranium. So they're hitting uranium there. Does that mean there's a big deposit somewhere around that uranium? No, it does not. But, you know, at least it gives them information where they can continue drilling and try to find and zone in on exactly where, you know, the uranium might be. Sky Harbor is another one, and consolidated uranium is a different story, but I wouldn't put them in the explorer category. But that was my strategy.
Right. So you're essentially looking for home runs and grand slams to make up for any losses in the rest of the portfolio.
That's correct.
Yeah.
Yeah,
So,
with these speculative companies, yes.
yeah. Do you have any rules in terms of position sizing that you employ in your portfolio? I know you said you're about 70% explorers, 30% producers, but within each category, do you have like I won't invest more than 10% in a single position, or like or not?
I don't. No, I don't have any rules. But what I've done is I've changed my allocations as information has come out. So, like, I've been doing these interviews for a little while now, and about 2 years ago, I'd say, someone asked me in the spring, well, you know, what's my number one? And I named a company, and I'm still getting comments on YouTube and Twitter because of that. At that time, the information that we had with the valuation of the company, I answered the question. That's my number one company because the valuation of that company at the time compared to its peers was better, and none of them had found uranium yet, except ISO. Sky Harbor was hitting a little bit of uranium, so was Alaska. But I mean, in terms of the ones that were sort of starting out their exploration, when I compared the valuation of that company to the other ones, like, they were undervalued to their peers. So when I had money, I was deploying where I can buy my soup for cheaper. And so and it turned out that company did very well for a period of time. They've been struggling a little bit lately because the conditions are very, very tough now for exploration companies. They need money to keep the lights on and to continue to try to find uranium when the conditions for raising money right now are absolutely horrendous. It's extremely difficult to find money, and so anyways, so. No, I do not have specific rules in terms of allocation, but as the information comes out, so for example, when Baseload came out with the fact that they found uranium in 2021 in their first hole, what I did then is I sold some shares that I have of another exploration company, and I started buying more of Baseload because, you know, they're getting good results. So when they're getting good results, I want more of that. And so, and I did the same thing with F3, Alaska, and Sky Harbor.
Understood. So would you say that because I mean, it sounds like you have kind of, traded between overvalued and undervalued, allocated that way. Would you still say you're more of an investor or a trader when it comes to uranium?
Yeah, I would not say I am a trader. No, I think that's not the right thing because, in terms of the times where I've sold, that has not occurred very often. So it's only when I saw when new information comes out and there's still valuation there. Like, for me, it still has to be at a good value. If information comes out in the company and then the value shoots up right away and it's really high, I'm not going to chase it. But if the information comes out and its market kind of doesn't really look at it, like, for example, Fission F3's news release last week about the 75 meters step out, the market the stock price didn't even budge. I think it went down, actually. And that seems to be excuse me, that seems to be a pattern that occurs a lot in uranium. A company will come out with good news and there's just nobody that really cares about uranium, which again is something that tells me that there's still so much value in the sector. Like, not a lot of people other than the uranium geeks and freaks like me who follow it really know. And at some point in time, these general financial markets are going to turn. All these worries about, bank collapsing and all that kind of stuff, money's going to come back to there's $7 trillion that's been invested in money market funds in the US alone. So there's a lot of money in the sidelines, and at some point in time they're going to want to come back in. And depending on what's going to happen with the uranium sector, the utilities are starting to contract again, and the long-term price is going to start moving up. Financial players are going to step back in, start buying uranium on the spot. The spot price is going to go back up, and then at some point in time, someone's going to say, okay, uranium is heating up again. We're jumping in. And this sector, when it moves fast and hard.
Right. The rock star of the commodities. So I looked at URA buying from institutional investors. There's actually, in my prior episodes, there's actually a chart you can look at. You can see how much institutional buying has been done on URA, the biggest uranium miners ETF out there. And what you'll notice is institutional buying keeps on increasing despite the drawdown that we've seen for over a year and a half now. So that's a sign that smart money is loading in. But one question that I've kind of pondered, and I think my followers have too, is that what's really preventing like a mid-sized hedge fund from just like squeezing the uranium price, just buying like a ton of spot and just squeezing it all the way up to the upside?
Well, there's nothing preventing that. And when you look at the 2007, I've mentioned this in other interviews, and if you can, or if you have interest, there's a report online. You just Google it, and Sprott came out with a uranium report in January. January of 2007. And I refer to that report a lot because it talks at that point in time, the price of uranium, the spot price of uranium was at $70 a pound. And in that report, they also have a valuation, they have a focus list of companies. They've got producers, developers, and explorers. And they've got all the stats on those companies at that specific point in time, their market cap, all that kind of stuff. And it's really interesting because in that report, Sprott states that they believe that at some point in time, the price of uranium is going to hit $100 a pound. And of course, we know now with history that it actually shot up to $139 a pound in July of that year, 2007. And what we know is that the financial players had a big role to play with regards to driving the price of spot up in that period of time. So, and when we look at, so I've been looking at this sector since 2016, invested since 2017. It's taken way longer than I thought it would, but it's okay because the fundamentals are just improving daily. But what I'd like to say is that there was one event that was really exciting, a lot of fun, and that was when when Sprott took over of Uranium Participation Corporation, and they started buying uranium in August of 2021. And the price of uranium at that point, I think, was $30 a pound, and they drove it to about almost $60 a pound in the span of about 2 months. And in that span, everybody was waiting for this. And so then people just piled into the equities. And our equities doubled, tripled, some of, in about 2 to 3 months. So now we know that there's Zuri Invest that any day now, any time now, they were supposed to start, buying uranium last month. Who knows why that didn't occur, but people are speculating that it might be because they had, a challenge in raising the $100 million that they wanted to start to buy uranium. So they're coming in. You've got Anu from.
I think they actually fulfilled that as of yesterday, that $100 million capital raise. I think that was actually fulfilled. That $100 million capital raise, I think that was actually fulfilled as of yesterday or a couple of days ago.
So I missed it. I apologize. Yesterday I was on the golf course, but but so yeah, so they're going to start buying soon. Now Sput, and I've mentioned this in other interviews as well. Like what is really good news, even though we're suffering, like sentiment in the sector is so bad. But what is really good news is the fact that, for at least the last half of last year, Sput was hardly did any buying in the spot market, like almost no buying. And then this year they bought, they were very active in January, and they started buying. But since February, there are very few days, like I don't know the exact number of days, but there are very few days in which they were at a premium to NAV, and they were able to raise money and then use that money to buy uranium. So they have had almost no activity in the spot market as well. And the spot price has, in over a year, last year it maintained around the $49 to $50 a pound price, but now we're around the $53 a pound price when there's almost no activity from financial players in the spot market. So to answer your question, what's to prevent hedge funds from driving this thing high? Nothing. And not only that, like, I mean, the writing's on the wall. You've got Sput that at some point in time, institutional money, big institutional money is going to start flowing back into Sput. If Anu was just, not Anu, but Zuri Invest was able to raise our 100 million, they're going to start buying again. So, any small purchases now, you see the spot price moving. So I track the spot price like on a regular daily, but I look at it 2 to 3 times a day. So that's going to start going back up again. And I think that's what's going to happen is, as the first one to dip their toe in, to start nibbling at something, and we see this start to rise, then people are going to start piling in because they'll want to participate, because there's anticipation. People know what happened last time, and now there's anticipation that it's going to happen again.
Yeah, lasting memory. So it sounds like there's quite a few similarities between this bull market and the 05-07 bull market. Now, I know you weren't an active participant, but you were an observer of that market. So number one, we have the financial players coming into this thing, like we had UPC, but now we have Spot, we have Zuri, we have the Yellow Cake. And
Yellow
you,
Cake,
yep,
and
exactly. Yeah.
and
So
Askar Badarbayev, who used to be with Kazatomprom, had an interview a few weeks ago, and he was talking about, he's now a consultant in nuclear and uranium industry, and he talked about the arrival of possibly another fund. He didn't give any details on it, but he hinted that there might be another fund coming in. So,
interesting.
and he was talking about actually like utilities, battling out to try to contract out these available pounds here.
Interesting. So, we've talked about the similarities of this between this market and the last bull market, although it seems like it's been magnified, this bull market. Are there any differences that you're seeing this bull market that we didn't see in 07?
There's very big differences. Grant Isaac, the CFO for Cameco, talks about it. He said, and so does Tim Gitzel, the CEO of Cameco. Tim Gitzel says in all his over 30 years experience in the uranium industry, uranium sector, uranium mining business, they've never seen, they've never, a contracting cycle, there's never been a contracting cycle that started with such a solid base as where they are now, where like, the price, the contracting price is like in the $50 range. Okay.
Mm-hmm.
And in the past, like they were starting from the absolute bottom. Now they're starting from a really good platform to start contracting. The other thing is, in the last bull market, there was production and big mines that were coming online. So to fill the supply need gap, or sorry, the demand need gap. So whereas here, you're looking at Cameco's capacity, they can produce right now with McArthur River and Cigar Lake and their share of that production, they can produce about 32 million pounds of uranium per year. In the last Cameco conference call, they announced that they have contracts to deliver uranium this year, contracts to deliver uranium next year. And so they talked about what those contracts look like for the next 5 years out. And in the past, their average book for future deliveries per year was 21 million pounds on average that they'd be delivering per year for the next 5 years. In the last conference call, they announced that has now risen to 26 million pounds. So at least for the next 5 years, Cameco's contract book is almost full. They can only sign another 6 million pounds of deliveries for the next 5 years because that's all they can deliver now with their 2 tier 1 assets, which are, the low costing pounds. So that's a sign that, and Kazatomprom, they announced a deal with China where CGN, one of the biggest nuclear utilities in China, where they want to contract, so buy more than 50% of what Kazatomprom can produce. So Kazatomprom's order book is getting filled. Cameco's order book is almost full. Now, Cameco, they have brownfield capacity as well. So they have other mines that they've shut down that they could open up again, but not at this lower price where tier 1 production. We're talking about higher prices. I don't know what those higher prices are. There's people that speculate on what those higher prices are, but you've got brownfield capacity that can come back online. So Cameco has mines, Energy Fuels, UR Energy, UEC has capacity that's ready to go. You've got Encore Energy that's ramping up. You've got Consolidated Uranium that might be able to start producing from an asset they purchased from Energy Fuels. Then you've got greenfield capacity in Denison Mines in Canada. You've got Global Atomic that started building their mine. You've got GoviEx that might be able to. You've got Paladin that can reopen. But all of this extra capacity needs much higher prices. So number one, the difference is that it's not the same in terms of production coming online that we had in the 2005, 2006, 2007 bull market. You don't have the same amount of capacity that can come online quickly to meet that capacity. Second is the outlook for nuclear energy. I mean, it's absolutely mind-blowing what's happened in the nuclear energy sector in the past 2 years, especially last year since Russia invaded Ukraine. I mean, that's forced countries to rethink and relook at their entire, energy strategy, where, a lot of countries were dependent on cheap material from Russia, cheap natural gas, cheap oil, where now all of a sudden, and the other thing is that you have the experiment, and Germany is the absolute flagship for that, where no, let's shut down all of our nuclear capacity and we're going to build solar and wind turbines, and that's going to generate green, cheap, renewable electricity, and that'll meet all of our electricity needs. Well, that was a pipe dream before. They built it out, and now we see the results, and everybody is seeing the results now. It hasn't worked out for Germany. As a matter of fact, the Germans are paying more for their electricity than most other European countries, and because they need to fire up some coal plants to be able to meet the gaps, because wind and solar doesn't produce electricity 24 hours 7 days a week. So the quality of their air is actually worse than most other European countries. And they also need to buy electricity from their neighboring countries, one of them, which is France. And France produces 70% of their electricity from nuclear. So I think people are seeing the irony in that, and how I'm not knocking wind and solar here. I truly believe that wind and solar has a place in the grid in terms of, you know, they have their capacity, but it's not meant to be 24/7 base load power that you can count on day in, day out, like nuclear. And, nuclear is the most reliable form of electricity. It's the cleanest, it's the cheapest, it's the safest. So, and every day now there's something coming out. There's information coming out where a country has committed to this, and this is in terms of nuclear. So we're seeing a shift in thinking. It's a nuclear renaissance at the same time as we have new technology in these small modular reactors, where some countries and some jurisdictions have actually started building these. When you look at the supply demand models that were projected for the next 10, 20, 30 years, SMRs didn't fit into these projections. And now there's information circulating out there. And again, these are all projections, so no one knows for sure. But let's cut the projections in half. So I read some information the other day that in 10 to 15 years, the SMR fuel demand could be about 180 million pounds a year, which is what traditional nuclear reactors are consuming right now. So what they were saying is the demand from small modular reactors could be the same as could double the actual demand for uranium. So, I mean, we're really sitting at a pretty, that's the difference between the last bull market. We didn't have that nuclear renaissance and this nuclear build out, and we didn't have the same supply demand fundamental imbalance that we have now. So, it's looking very promising.
Yeah. So I may have missed this, but when were those projections accounted for? Like what time frame? How far
Well,
into the future?
there's different organizations that make projections into the future. Like the WNA comes up with one, and so and if you look at that, you see that the demand for uranium is going to be growing at about 2% on average per year. But like I said, those projections don't factor in the build of new small modular reactors. Now, the people that do these projections, they need to factor this in now. We have small modular reactors that are actually under construction right now. They also don't factor in the nuclear reactor extensions that have been approved, where nuclear reactors had been scheduled to close on such and such a date. But now a lot of the utilities are applying for extensions, and they're obtaining them. They're obtaining 10-year extensions, 20-year extensions. Biden in the Inflation Reduction Act, actually, there's money in there for utilities to be able to, extend the life of their nuclear reactors. That was absolutely unheard of from any government in the past, especially from a Democrat government, where they traditionally had been anti-nuclear, but people realize now that you can't do it without nuclear.
Yeah. And I kind of want to pull on this geopolitical string that you brought up earlier in the discussion. So in the event that Russia decides to ban their uranium services exports, what would be the downstream effects of that in the uranium market?
Well, Russia does not account for a big portion of the uranium supply in the world. They do. Rosatom does supply uranium and uranium fuel services, but they play a more important role with the provision of conversion services and enrichment services. So if they ban those services, that would have an immediate impact. However, I think that since they invaded Ukraine last year, the Western, we're going to call it Western friendly nations and nuclear, just electricity utilities that are in those friendly nations now realize, I think they've taken steps since last year to try to find enrichment and conversion services other than in Russia. And and the proof of that is that the price in conversion and enrichment services increased substantially last year, especially after within the first 3 months of Russia invading Ukraine. So put yourself in the shoes of a utility. You want to keep running your nuclear reactor. What do you need? What do you need like right now? And what I mean right now is, like, let's say you need to do a fuel assembly change. You need to change the fuel rods. Well, you need fuel rods. Well, you probably have already an assembled fuel rod ready to go, fuel rod assembly ready to go. But I mean, if you had to change it again in another year, do you have the next one ready? So that's what you would focus on first of all, is your rods. But before that, then in order to get the rods, well, you need enrichment. So last year in 2022, Cameco saw a lot of orders in January. That's before Russia invaded Ukraine. The utilities started to shift their focus to contracting for U308. But when Russia invaded Ukraine, utilities noticed, whoa, I'm buying my enrichment services from Russia, and what the hell is Russia doing now? I'm buying my conversion services from Russia, and look I'm not sure I want to keep doing business with Russia. So they shifted their focus to buying enrichment and conversion and trying to find capacity other than in Russia. And there isn't enough capacity outside of Russia, which is why the price went up substantially. Now, enrichment and conversion capacities will come online in time and with the proper pricing. So there are facilities that could be upgraded, that could be built, but these are expensive propositions. And so when the price is right and when the demand is there, then the services will be provided. So to answer your question, there wouldn't be a big impact on the price of uranium initially, but the impact would be felt on enrichment and conversion services. And we've already seen that last year. And if there are, still Western friendly utilities that are buying services from Russia, well, then they'd be up shit creek without a paddle. They'd be late to the game to try to find enrichment and conversion, and then they'd have to find that and pay the premium.
Gotcha. Well, let's go ahead and shift gears and let's talk a little bit about overfeeding. When do you anticipate overfeeding significantly impacting the uranium spot price? Because we've been hearing about overfeeding for several months now. That any day now that we should be seeing the downstream effects of it.
I really have no idea, Danny. To be completely honest, I'd like it to be as soon as possible, but I really don't know. I don't talk to utility fuel buyers. I don't talk to conversion facilities. I don't talk to enrichment facilities, so I really don't know. But I do know that like Justin Hewen has done a lot of work on this, and his work is accurate. And it's also backed, like, again, Grant Isaac from Cameco talks about it, that like these are all real things that are going to be occurring, and it could mean a pretty important shift on demand for physical uranium at some point in time, because you're going to need to be feeding more material into the converters and into enrichment to be able to obtain your final fuel rod assembly, your SWU. So I don't know, but I'm thinking that with the lag time between, okay, now we've got conversion, we've got enrichment, we've got conversion, and I think that it should be, I'm expecting it sometime this year, but I really don't know.
Fair enough. And so we've been covering a lot of ground when it comes to all this positive news in the uranium space. We've been kind of consolidating over the last year or so. Why do you think that despite good news after good news after good news, we haven't really broken out of this consolidation pattern?
Because of what's going on with the world financial markets, because of the uncertainty, the Fed's raising rates, people, all recession fears, all kinds of
Exogenous
negative,
factors. Yeah.
yeah, negative financial market, factors. I think that people has just like been very scared as to, and you hear it, like you hear it on the news, you hear it, you read it everywhere that people are scared. We've had some bank failures in the U.S. People are scared that there's going to be more bank failures. People are thinking back to the 2007, 2008 world financial crisis, that people are thinking that we might be headed towards something like that again. So there's a lot of money that's been just pulled right out of financial markets. So, and you see it, like if you look at the valuations of, the big names like Tesla and Netflix and some of the big names, like their valuations have gone down 40 to 50 to 60%. And when you're cutting, when your valuation was 800 billion, or sorry, 800 million and, or 80 billion or 400, like, then, that's a lot of money that's being pulled out of the markets.
Yeah.
So, and it's still in the sidelines. So while sentiment remains the same, which is negative, and while money stays on the sidelines, I think it's going to continue. You call it a consolidating phase. I call it bouncing off the bottom. We're bouncing off bottom. We've got good days, bad days, but basically we're kind of in the same sideways pattern. I think that's what it's going to take, like some sort of, sentiment's it'll have to turn dovish rather than hawkish. And I think that's when we're going to start seeing money coming back in. And that may occur around the same time when, uranium starts picking up again. So hopefully it'll be two good news for us at the same time.
Yeah. I mean, the reason why I asked this question is I just see it all the time on my comment section on the YouTube channel or my Twitter feed, which I'm sure you see it on your side too. So I kind of felt incumbent to ask it just for, the followers, just to kind of get an answer from you. Excellent. So current price action in terms of the metal and in terms of the equities, how do you what's your evaluation there? Are we on the verge of a breakout, or do you just see a little more consolidation in the future?
Okay, so again, I'm not a technical expert or a technical,
Right.
I'm not a trader, but what I see is I see sentiment in the metal
Mm-hmm.
actually very, very strong for the reasons I've already explained. Like there's been very little action on the spot market, and the price of the metal through all of this has maintained its strength last year at around 49 to $50 a pound, and then this year has increased to $53 a pound at a time when sentiment in the sector is absolutely no good for the equities. So the equities I find are kind of lagging here, but that's okay. So and I think the reason for that is because retail and people that buy the equities are not the ones that are buying uranium. So, there's people buying uranium right now because that they need uranium, and that's what's sustaining the price. And people might not realize that. So that's why money's not flowing into the sector. But at some point in time, that spot price and that term price is going to start going higher again, because we've maintained that floor for over a year. When the financial markets went, just like, everything lost 40 to 50%, not the price of uranium. The price of uranium has gone up. So the equities have gone down 40, 50, 60%. And some of them are still low, quite low. So I think that, the price of uranium is still strong, and I think that it's going to continue to show strength. And at some point in time, the uranium equities are going to catch up.
Yeah, and to your point, there is a lot of money on the sidelines. If you look at like the M2 money supply chart year over year, I mean, we're seeing the biggest declines in M2 money supply. So I think since the Great Depression or something along those lines.
Yeah.
And when you dig in deeper, you'll come to find out that that money is just fleeing from the economy and into treasuries, more specifically short-term treasuries. So there's a lot of anxiety in terms of like, where do we put it? Where do we store our capital? And just short-term U.S. debt is kind of the place to be right now. But yeah, once that capital begins to flow out of there, I think uranium in the commodity space would be a natural home for all that.
Yeah.
Well, great. Exit signals. So we've talked about, your entry point. We've talked about, you've been in this bull market since inception, essentially. I think technically the bull market began in the last bottom, which was in 2016, which is, I think, essentially what you've essentially wrote all the way up until now. But what do you look for in signals for an exit? What are your biggest, what are the hallmarks of what you're looking for to, call it one and done on the uranium sector for this cycle?
That's a good question. And that's changed for me actually, because again, more information, like, so at one point in time, like I kind of had this list of things that I had in my mind in terms of when would it be time for me to exit. And I think now that's changed. I think it won't be a complete exit. And the reason for that is because of just the growth signals that we're getting in the nuclear energy sector, which means that the uranium producers, uranium miners, it's going to be a good sector for them for the upcoming years. And a company like Cameco is going to start making pretty good money, paying dividends to their clients, that kind of thing, maybe expanding, who knows. But they're sitting pretty right now. They're so well positioned. So for me, it's going to be when I start exiting some positions or trimming positions. It's going to be when the price of uranium has increased to a level that I think is going to be high enough. It's when I'm going to see the price of the uranium equities go up to a level where I think, okay, it might keep going higher, but this is good enough for me. And it's going to be evolving. So it's very difficult for me to tell you it's A, B, C, and D, but it'll be kind of keeping a close watch on, all right, okay, this position has gone up so much, it's time to take the profits and run. So yeah, that's how I'm going to play it.
Great. Well, we've covered a lot of ground in this interview. I want to be mindful of your time, Terry. Before we head out, though, do you have any closing thoughts for the audience, and where can they reach you?
Well, I'm on Twitter, so people can send me a direct message on Twitter. So I guess my closing thoughts would be, I thought when I got in and started buying the equities in 2017, I was telling everybody that I think it's going to be a 3 to 5 year play. I was hoping it was going to be quicker than that, but so that's been a lesson. It always takes longer, especially in uranium. But I see the comments, people saying, oh, if someone tells me we're just on the cusp, wait another whatever, like I'm not telling people that. What I'm like, because I don't know, and I've never known, and I've always said that I've never pretended to know when this was going to really, come to a point, where we're going to get the returns that we've been expecting. But what I want to say is the fundamentals are just improving. And I've been talking about a coiled spring, and I've been saying how coiled that spring is, and it's just getting tighter and tighter and tighter and tighter. And, I say with certainty that that's true, that spring is getting really coiled, and at some point in time, that spring is it's gonna break. And I think, the more good news we're getting, the more information that's coming out there, the more positive it is for nuclear. Then there's all of the factors that we talked about, like overfeeding and demand, supply imbalance, all that kind of stuff. We're gonna have our day. I
Yeah.
don't know when it's going to be. I wish it was sooner than later, but I'm confident that we're going to have our day.
Excellent. Well, if you enjoy this kind of content, please hit the subscribe button if you haven't done so already, and hit the like button on this video. Also, leave us a comment if you disagree with any of our points. I will happily, go through it and answer it. With that said, Terry, thank you so much for coming on, and I will see you guys next time. Bye, y'all.
My pleasure. Thank you.
Yep.